Hi, I'm Terry Munselle of the Munselle Group with Compass in the Desert. This is the first week of July, and shortly we'll be getting some numbers that will take us through the end of June. But I have current numbers, and everywhere I go, when I go to a listing appointment, or I'm working with buyers, or I go to a cocktail party, the question, of course, is what's happening and where do you think we're going, Terry? And I have, and many savvy realtors have at their disposal, numbers and things that will help you understand what we understand. I do through my association with two of the top real estate brain groups in the U.S. right now, which would be the Ferry organization and the Keeping Current Matters organization. So what I thought would be helpful for you is if I went through the slides in an order that can help you. I just want to help you get up to speed with where I'm seeing the market and where they see the market, so we can understand and make plans. And I think that's the only way to look at it. So with that, I'm going to jump right in. And these slides will be on my website so you can see them, but let's just follow along and take a peek. There are certain facts we know. One is inventory. The months of inventory for homes for sale today here's January 11 all the way to January 21. And this is in the U.S. from the National Association of Realtors. Take a look. Well, we're down to under 2 months. We know that. Back in 11, we had about a 9-month supply. The desert, we've always had more than our share because we're always considered a resort place where you had second and third homes. That's changing. We're becoming much more of a primary place, and we're seeing that affect our months of inventory. But with that, then on the national average, we're under 2 months. And the question is, where does everyone see it going? Look here at seller traffic in the U.S., and this is through first quarter, which would be through end of March, but I suspect it hasn't changed much when we get the new numbers. Seller traffic is super low everywhere, very weak. There's not many sellers. We know that. And why is that? A lot of that might be because they don't know where they're going to buy, right? And so they're hesitant to come on the market, not knowing where they're going to sleep. Kind of a big deal. Look at buyer traffic across the U.S. Does that tell the story? You've got very strong, take a picture of that. We know that. And it's across the U.S. Look at existing home sales. And this is by region and total U.S., which is super interesting. Year over year in the U.S. through March was 33.9% above the previous year. Now remember, COVID shutdown started March 15th of 2020. So this is year to year while we were all selling things at a normal pace. Look at the West, 53.8% over the prior year. Look at pending home sales. So these are the things that were in escrow at the end of March. So they would be closing April and May and maybe June. And you look across, the Northeast soared. Look at that, 96.5% over prior year. Now we were in the shutdown April, May, June. So that's an interesting statistic. June 15th is where we, opened up to show homes, but we were totally closed from June 15th until June 15th. Look at the price appreciation. This will help you see. We'll get to a total here in a minute, but I want you to see these things. Price appreciation year over year, quarter one sales. In the total U.S., prices were up 12.6%. In the Pacific, the whole West Coast, it was 14.3%. And then you can go back and look at the others across the board. But we already knew that, and that was through March. And in the desert, we were just starting. January, February, March, prices were starting to go up. April, May, and June, they really went up. Price affordability. This is the part that I want to really get into. Look at across the board here from 1990. This is an affordability index. In 1990, the index was 108. In 2006, right before the recession when things were going high prices, it was 108. During our recession, with all the distressed properties on market, that meant more people could afford those lower prices when we got up to 197 index. Look where we are today in the U.S. It's 174. So why is that? Well, there are a lot of reasons. We'll just kind of review quickly here, but this is one other chart next that I want you to see. This is the percent in the U.S. of the median income needed to purchase the median priced home. Now think about that. So in 2006, the median income needed to purchase the median priced home was 25.4%. That's a big percent of your income, right? We're now down to 14.4% on the median income to buy a median priced home. All it's saying is homes are affordable based on the interest rate, based on the income of people that are buying homes, etc., and the amount of income they have at their disposal. I want you to see this chart. People are always shocked when I tell them this. Go to the bottom left. This says residential properties with a mortgage. 31%, almost 32% of those people in the US have at least 50% equity in their home. I know. And now look to the bottom right. 38% of all homes in the US have no mortgage. There's a lot of money sitting in homes and real estate, and a lot to be freed up once sellers feel like they can find somewhere to buy. You're going to see a little bit more inventory come onto the market. But here's the issue. New home inventory. This just shows where we go all the way across the board is a very, very low compared to last year. When you get to April at 4.1 months supply of new home inventory in the US, and we all know it's expensive. Concrete, lumber, we're having shortages on products that make a new home, and those are increasing price, and a lot of in the desert, we don't have much new building anyway. So, and certainly in country clubs, there aren't a lot of new clubs that are going to be built in our lifetime. So with that, when I go here, I wanted to pull this. This is from Robert Dietz. He's a chief economist. He says, while housing starts were strong at the beginning of the year due to home builders constructing homes that were sold pre-construction, higher costs and limited availability of building materials have now paused many products in the U.S. That's why. We'll see when that can happen, that it would grow again, but right now it's not. This is from a study of economists that says in the U.S., when will U.S. housing inventory grow again? Well, some of them said, 10% in the first half of 21. Not really. The second half said in the second half of 21, possibly. Most of them are saying 26, 12, and 9% is 2022, 2022, and 9% say 2023 or later. So the consensus is prices are higher for new. We still have a lot of pressures on our inventory. We're not going to see a lot of new inventory to soar shortly. This is from JP Morgan. The main point here is home buyers' interest rates are still low, and even though they're going to inch up, they believe housing prices have spiked. They do not expect to see housing prices falling. And in fact, they're more likely to keep rising. It says if you're looking to purchase a new home, conditions now may be better than in 12 months from now. So people are nervous that have lived through 2000, 2006, and 2007, but they're saying we do not believe this is the case today. From JP Morgan. From a strategist from Morgan Stanley, we have a strong conviction that we are not experiencing a bubble. We are not at all suggesting that appreciation will maintain its current pace. How could it? Home prices will continue to rise, but more gradually. And then from Goldman Sachs, strong demand for housing looks sustainable. And even before the pandemic, these mortgage rates had pushed demand to highs. But as a result, this model projects double-digit price gains both this year and next, meaning in actual sales. And then when you look down Morgan Stanley, the euphoria in today's home prices comes down to the simple logic of supply and demand. At Morgan Stanley, they conclude that this time the sector is on a sustainably sturdy foundation. The robust demand and highly challenged supply, along with tight mortgage lending standards, may contribute to bode well to the home prices. Higher interest rates and post-pandemic moves could likely slow the pace of appreciation, but the upward trajectory remains very much on course. And these are the points for people that keep saying, I'm going to wait. I get a lot of buyers saying, I'm going to wait till January, February of 2022. As a realtor, we're not seeing it, and this is why I want you to have some real ideas from top thinkers in the U.S. And Lawrence Young, the chief economist from the National Association of Realtors, says this is not a bubble, it's simply a lack of supply. And that lack of supply has been created from all of the millions of first-time home buyers entering the market. We're seeing in the next 5 to 10 years a generational wealth being transferred to younger people, and they already have a lot of disposable money right now buying homes in the younger, and when we see the millennials start buying even more, we're going to see an issue contribute more to the loss. We have hedge funds and countries buying a lot of the home supply in the U.S. right now to use for rental properties. And we've simply got people making life choices, changing areas and upsizing or downsizing based on what happened during COVID. And obviously, interest rates are perceived to be low now and not to be soaring in the near future. So I'm hoping that helps us. When I have this understanding and I can impart that on a buyer or a seller, I think it will help people make decisions, responsible decisions for their future based on actual facts and not just feelings. Obviously, with what we went through in COVID, anything can change fast. But this is where the top thinkers in the country are right now and how they're planning their businesses and their investments. So if you'd like to talk about your personal buying or selling, please give me a call. I'd love to chat with you. In the meantime, stay cool.